Here's something I want you to know. 6 reasons you should consider this basic options trade, risking $150 to potentially make 500 plus. Reason number 1, we're looking at the Russell futures against the Nasdaq futures, 2 tightly correlated markets. Right now, the Russell is staying somewhat strong relative to the Nasdaq. The Nasdaq is cheap relative to the Russell. That's the first reason. Nasdaq's going to be the white, Russell still the purple. Now what I did is I put volatility bands. The white is going to be Nasdaq volatility bands, and the purple is going to be Russell volatility bands. So if we go back to 2019, you can see the volatility bands are a lot more narrow because volatility was a lot lower. After COVID, volatility spiked. The expected move of the front month option contracts was a lot greater. You can see how volatility is still elevated. In 2022, right out of the gate, Nasdaq and Russell fell. Both fell. Nasdaq was far weaker than the Russell, and right now it's at its lowest point through its volatility bands. Now, because of options pricing, the volatility bands are going to work as resistance and as support. So the Qs or the Nasdaq are trading right down to their implied volatility support. We share trades like this throughout the week with our members. So the first 2 reasons. 1, Nasdaq is cheap to the Russ. And 2, Nasdaq is sitting on volatility bands. Well, 3, let's find optionable Nasdaq stocks using our proprietary scanner to find names that are going to move if the market were to bounce, because the Nasdaq is inexpensive relative to the Russell. So I want stocks with a high beta. Beta is a measure of overall systematic risk. The higher, the more volatile. After going through the names, the stock that I settled on is SMCI, Super Microcomputer. Now we're looking back to October of 2020. We're looking on a daily. Now, each one of these green and red lines is going to be the stock's expected move for those front month options. So here, the expected move or the volatility of this month is less than the volatility of this month. You see, the expected move is greater than the expected move here. SMCI closes within its expected move 84% of the time on this chart, which is going back 2 years. That tells me that the market makers are darn good at pricing the options in SMCI. Notice how the stock is trading right down to that lower implied band, the lower expected move. Well, if it closes in 84%, seems like there's a high probability that the stock may just bounce at this crucial level. As we reiterate weekly to our members, in order to make money, in order to get into profitable options, when you're buying, you need those suckers to move. You're buying premium, you're buying movement. When you're buying options, we like to buy options so you always know your risk. When we're sharing trade ideas with the members, we always want to know exactly what our risk is. The risk of this trade that you're going to see is $150. When we buy options is we need a catalyst. And SMCI has 2 catalysts. The first catalyst is going to be earnings. And so what I did for SMCI is I looked at its last 4 earnings moves. And in its last 4 earnings moves, it moved 18%, it moved 32%, it moved 5.5%, not as much. And this day it moved 19%, big move. So this stock does like to move on its earnings. So like clockwork, earnings comes around 4 times per year. The next earnings cycle, we're going to expect some movement. That's a catalyst. Now we're looking at SMCI options. And I want you to look at this number right here. This is the volatility out in November. This is when SMCI is going to report their fourth quarter earnings. So if you want to be in the correct earnings cycle, if you want to play their earnings, you would need to be in November, not in October. So I want to focus on November. So let's just say this is $12. So the expected move is going to be $12 higher and $12 lower of this price. We need to make the decision, is that fairly priced? Is that enough movement priced into SMCI over the next 59 days, or not enough movement? Right here, these 70s, these are my favorite. Mid-market, obviously the stock's going to move a little bit, but if you go through the 6 reasons, the Nasdaq is cheap relative to the Russell. The Nasdaq is sitting on its annual volatility bands. We were looking for Nasdaq stocks that can move using our scanners. Out of the 10, my favorite is SMCI. At the time of this video, SMCI is trading down here at $56. Remember, it closes in 84% of the time. So there's good probability going back the last 2 years that SMCI rallies from here. We also have an earnings catalyst. This sucker's going to move. In my opinion, we have inexpensive options premium. So think of it this way. This is about 23% of the overall stock price. If SMCI moves just 15% on its next earnings release, just 15%, hopefully it rallies. That's the bet, that it rallies. If it moves 15%, right now it's priced about 23% over 59 days. If it moves 15% on earnings, being extremely conservative, right? Even 20% is probably conservative. But if it moves 15%, that leaves 7 extra percent for the other 58 days. If you like this idea, and hopefully you follow it on paper, tomorrow we have another catalyst. The Fed is going to come out with their decision on interest rates, and the market is going to fly. The market's going to move. It's got the potential to rally, and if it does, SMCI will rally along with it because it's got a high beta. That's that systematic risk. I like the 70s in November, paying mid-market. This is a great one, a paper trade. If you buy this for $1.50, that is $150 of risk. You can never lose more. If after 59 days or at expiration, the stock trades up to 75, it's going to be worth $350. If the stock trades up to 80, that 150 is going to be worth $850. And this name certainly knows how to move.